Okay, wait a minute, you gotta get a picture of the front.
Okay, go ahead.
Other income, page 86.
Okay.
Are you recording me?
Yes.
Is this video?
Yes. Getting you some new customers.
Page 86. You have to be careful who you show this to. Okay. And in section 86, there's another one. Other income, right? Estate and trust income. Okay. And it says, an estate or trust, unlike a partnership, may have to pay federal income tax. If you are a beneficiary of an estate or trust, you may be taxed on your share of its income distributed or required to be distributed to you. Does that make any sense to you?
No, it sounds like legal speak.
However, there is never double tax. Estates and trusts file their returns on Form 1041, U.S. Trusts, U.S. income tax return for estates and trusts, and your share of the income is reported to you on Schedule K1 of Form 1041. Okay?
Okay.
Current income required to be distributed. If you are the beneficiary of a trust that must distribute all of its current income, you must report your share of the distributable net income, whether or not you have actually received it.
Okay.
Does that make sense to you?
In a statutory trust, yes.
Well, you gotta pay income tax whether you actually receive it or not. So if you don't have if you don't get the money, you owe the income tax anyway. Isn't that what I just said? Distributable net income, whether or not you have actually received it. So I give you $100,000, you have to pay taxes on it, and I keep the $100,000.
So what's the point of having a beneficiary if they're going to get taxed on it?
Well, there's a couple things. One is some beneficiaries have so much money they don't want to even get the income. Okay, that's one part. The other part is the trustee may decide not to distribute it and use it for investment in a better situation, so the beneficiary in the long run gets more money.
Okay, so what is this statutory? What are we talking here? Statutory? Are we talking?
This is the law of the IRS. This is IRS. This is what the IRS is telling people.
Right.
All right. So, current income not required to be distributed. If you are the beneficiary of an estate or trust and the fiduciary has the choice of whether to distribute all or part of the current income, you must report all income that is required to be distributed to you, whether or not it is actually distributed to you, plus all other amounts actually paid or credited to you, up to the amount of your share of distributable net income. Okay?
Okay.
How to report. Treat each item of income the same way that the estate or trust would treat it. For example, if a trust dividend income is distributed to you, you report the distribution as dividend income on your return, so on and so forth. I don't have to tell you the rest. I can only tell you what George Bush's accountant told my teacher, who he mentored. He mentored A, and B. He mentored A, and A told me how it really works. George Bush's, and this is from George Bush's accountant to my teacher's teacher. Because they were both in prison together.
Really?
Really. And that's where you swap all your best deals. So this is how it works. You've got to use a country that doesn't have income tax. And usually it's the Bahamas. They don't have income tax. So you make a beneficiary in the Bahamas. Some company will say they're the beneficiary and give you a address in the Bahamas, okay? And so they will tell you the name of their organization. So the trustee distributes the money to the Bahamas. But they pull it out of their checking account here in the United States. So it looks like they took the money out, 100,000, 200,000, whatever. And they send it to, and the paperwork says they sent it to the Bahamas. And the company in the Bahamas claims they got it, but they're not taxable. So they send back to the United States a form called 1040 NR, non-resident. And then after that's received, the trustee puts the money back in the bank account.
Dirty. Very nice.
So there you are. That's how that works. We did it, and this is what happened. All these licensed people, be very, very careful of licensed people. They're very, very arrogant. So we told our biggest trust about this and how to do this, and we told him to call our connection. We told him how it was done. We told him to take the money out of the bank account. He didn't call our connection, and he didn't take the money out of the bank account. And that's what blew up Kensington Fund, the first one we did. That's what blew the hell out of that, because then they started looking for other people that had filed that way, other trusts that filed that way. And that's really a big mess. I mean, we had we had proof with the paperwork that we'd done it right, but they didn't care.
They went after you anyway.
Sure. So that is part one of why we've had so much trouble. And I told you the other one, part two, last night.
Yes.